Hey, Danny,
What's up, Chris?
there's a local woman who lives here in town, and she set all of her mortgage documents on fire.
Okay.
Yeah, her name is Bernadette.
Man, I don't know. You really got me that one time, and it's been flat since. I'm sorry.
Hey, I at least entertain myself, right? I'm
that's
here
true. You
giggling,
do.
trying
You sure
not
do.
to choke on laughter as I say these ridiculously bad jokes. You can't say my joke wasn't on point, because today we're talking about mortgages and down payments.
All right, I'll
On a
give that to
home.
you.
Yeah.
That I will concede.
Welcome back, everyone, to the Financial Philosophers podcast. Yes, so today, Danny, we're going to talk about this big life decision that a lot of people encounter. So, to our listeners, specifically, we're talking about you want to buy a home, you're thinking about buying a home, and you have to make a decision on, what kind of mortgage should I get and how much of a down payment should I make, right? That's going to be the focus of today. It's a big decision for a lot of people. There are a lot of pros and cons to whatever choice you make, so it's often difficult to know what the right thing is at any given time. It's going to depend on your situation. But there are really kind of four big questions we want to focus on today. So, how much of a down payment should you make? 5%, 10%, 20%? What mortgage length should you choose? Should it be a 30-year? Should you do a 15-year? Should you get a traditional mortgage or an FHA mortgage, Federal Housing Administration mortgage? And then lastly, is there, anything you could do beforehand, before approaching the table, before making that big decision? Is there anything you could do beforehand that might improve your options or improve your outcome? I think that's what we want to focus on today.
Okay, that sounds great.
Yeah. So we'll start with the first one, Danny. How much of a down payment should you make? What are some of your initial thoughts on that when you think about that question?
Initial thoughts. From the outset, I would love to put down 20%.
Mm-hmm.
That, especially in today's day and age, is pretty difficult to do for most people, and I'll get into an example of that in a minute. But it depends. I would say as high as you can, like reasonably can.
Mm-hmm.
If you can reach that 20% down payment, then it sets your initial loan, loan to value ratio at 80% or less. Then you don't have to deal with the mortgage insurance, which does increase your monthly payment by a relatively small amount usually. I know that we certainly did not have 20% to put down when we bought our house. We were more in the 10-ish range, maybe 8% probably. And we paid P.M.I. for a couple of years until we were able to refinance. And by then, the house appreciation had allowed that loan to value ratio to decrease below 80%, and we got rid of P.M.I., which was very nice.
That's awesome.
So all that being said, I like to put down more. However, in some areas, it might quite literally be impossible for a lot of people in Northern California. And, for kind of the average house out there, they are great savers, but even they couldn't put 20% down, because if the average house costs $1 million, then 20% is a $200,000 down payment.
$200,000, yeah.
So
that's a lot of money.
It's gonna vary depending on your means and your savings rate and the area that you are choosing to live in. Very high cost of living versus low cost of living.
Yeah, I completely agree. I do agree with you that, especially in today's mortgage interest rate environment, I think you want to do a quick Google search, I'm seeing, average 30-year rates getting in like the 7%, 7.5% range, right? And so just on that information alone, it is really enticing to want to make a larger down payment. But like you said, not everybody has that money just sitting around
Very true.
to do that. To emphasize though just how enticing that is due to the high interest rates right now. I think back to when we were on, I think it was episode 5, looking at debt payments as an asset class.
Yes.
You and I talked about um, compare the interest rate on whatever debt in question you're paying off, and ask yourself, could I reasonably get the same return on investment by taking risk in the market or other
Very true.
asset classes, right?
Yeah, because debt repayment, there's no risk connected to that.
Right.
Whereas in order to get those higher returns within, say, the stock market, you are taking on much more risk.
Right. And then we also talked about the after-tax return in that episode, right? Like if you were investing in a taxable brokerage account, what rate of return would you have to get in order to equal, say, a 7.5% mortgage interest rate, right? Because that's just a true 7.5% return, if you will. And so if you think of a simple example, like somebody who's in the 22% federal bracket and maybe like a 5% state tax bracket, then you're looking at like around a 10% return you'd need to get to equal a 7.5% after-tax return.
That's a very high return. Yeah, that is very difficult to reach.
Yeah, and so it's really enticing to want to say, if you can do that 20% down payment, more power to you. You certainly, I'm not going to fault anybody for doing that given current rates, and if they're especially trying to buy a house in this environment. To your point though, that's the biggest thing right there is like if you make less than a 20% down payment, you generally have private mortgage insurance known as PMI, and that does vary, right? I mean, it can be anywhere. I tried to Google online, like what is the average PMI rate, if you will, and you get a range of like 0.25% up to 2% of the loan amount per year in PMI. And it just totally depends on like different factors.
I will admit, I don't actually know what the percentage rate of our PMI was. I just know that it was costing us an additional $150 a month in cash, basically.
Yeah. 2% did sound high to me. Like I've seen PMI tacked on before on mortgage quotes, and if my memory serves correctly, I don't recall it being at a 2% rate, but I wouldn't be surprised if it was somewhere in the middle of that road of that range, right? And it has to do with
do you think, sorry to interrupt, do you think that percentage rate for mortgage insurance increases as kind of national rates increase? Is that tied in any way to kind of the federal interest rate and how that trickles down to everything else?
I don't know.
Okay.
Like, I don't know the technical answer to that. My intuition tells me that it would, because the whole point in private mortgage insurance is to protect the lender in case you were to default on making payments to your house. And if interest rates are higher, that means payments are also higher. It's more demand on people's cash flow. And so I could see there being a case for PMI increasing if interest rates are also higher, but I actually don't know for sure. I haven't actually researched that.
Okay.
But there are certain things that do affect your PMI, right? So generally, like the larger your loan, the worse your credit score, the worse your debt to income ratio is. All of these things can contribute to your PMI being higher if you make less than a 20% down payment. So, when it comes to deciding on what amount somebody should make in terms of a down payment, there are different things you have to consider. And Danny, you already talked a lot about them, like, what's your emergency fund like? What's your current situation like? Think back to when we were talking about the emergency fund episode we did. As a clarification, your emergency fund technically should not be used to make a down payment on your home. That is not an emergency purchase, right? It's
correct.
Supposed to be.
And something that is very common after you buy a home is almost always life happens and something breaks and you have to pay for a repair, an unexpected repair in the year or two after you purchase the home. So you definitely want to have that emergency fund, properly allocated and set to the side and not connected to your down payment.
Absolutely. Yeah. If you're saving in an account for a down payment on a home coming up in a year or 2 or 3 or whatever it is, that is one goal. It should not be tied or intermingled with your emergency fund, in my opinion. I think those should be separate. But yeah, so, you have to ask yourself, do you have enough cash available or set aside to make a 20% down payment? Or do you need to, sell other assets, right? Maybe you have a brokerage account that you could dip into. Hopefully you would have assets that are at a gain that you wouldn't have to sell at a loss in order to help with a down payment. It becomes complex pretty quickly when you start considering these different things. One thing I will say, just as a quick shout out, I have noticed when I've helped some people look through mortgage quotes, there sometimes there will be like a relatively attractive looking interest rate. It's like, oh, that's interesting. I'm pretty sure that the national average rates are just a little bit higher than what I'm seeing on this quote.
Yeah, low. You're seeing something lower than what you would expect on the national level.
Yeah, and then when you look at it, sometimes they try to build in something called like mortgage points, where you make part of your down payment goes towards prepaying some of the interest to get your points to get the interest rate down.
So the rate that they state, if you actually dive into the itemized section of that contract or that proposal, involves the purchaser paying interest up front, not paying off some of the principal with that down payment.
Right.
Okay.
Yes. Yeah.
That's a little tricky. That's something to watch out for.
It is. Yeah. And it's not that it's necessarily a bad thing. I don't generally see it being the default best thing to do. I generally see it being more attractive to just make a larger down payment and don't prepay interest. Because if you're buying mortgage points, that's going towards towards interest. It's not affecting your principal at all. So it begs the question, especially in a high rate environment. Yeah, it might be tempting to have that attractive looking interest rate that's a bit lower than what current rates are, but are you really just doing that for like a behavioral purpose, like peace of mind? Like maybe you're better off just putting more towards the down payment to begin with, rather than buying points. You have to weigh the pros and cons. But I generally don't see many people doing that, but it's just something to be mindful of if you see that show up when you're kind of shopping around for different quotes and whatnot.
All right. That makes sense.
Yeah. Another quick shout out for something, since we're on the topic of PMI. I've noticed this a lot, where there will be two quotes that somebody will get. They're making less than a 20% down payment. For example, maybe they're making a 5% down payment or a 10% down payment. And there will be a traditional, conventional mortgage where it's your principal and interest payment plus PMI, right? And a certain interest rate. And then there will be another conventional mortgage quote from the same lender where the interest rate is just slightly higher, but there's no PMI. And it just so happens that the starting monthly payment is a little bit lower than the first option because the PMI is not there, right? Now, what they've effectively done in this situation is they have baked the PMI into the mortgage in the form of a slightly higher interest rate, and you're paying that over the life of the entire loan, say 30 years, as opposed to having a slightly lower interest rate, but with PMI.
Interesting.
Where the PMI would naturally disappear once you hit that roughly 20% equity in your home some years down the road.
A quick call out on that is that typically it doesn't automatically disappear. You, as the homeowner, have to initiate that process most of the time. From what I've seen and a lot of what I've read, usually the mortgage companies and typically the larger banks or institutions that have purchased that mortgage after you've bought your home, they aren't usually being proactive in getting rid of PMI and reducing how much money they're making off of the homeowner.
Really? Oh gosh, that surprises me that they wouldn't go out of their way to to benefit the buyer. So no, it's a great call out, Danny. Technically it is supposed to drop off once you hit a certain percentage, but that is a good point. I think just take the responsibility in your hands that once you hit that 20% equity part, just call your lender and say, hey, let's get this PMI taken care of, right? This shouldn't be on here anymore. And don't just be looking at your remaining debt, right? Danny, to your example, your house appreciated in value, which expedited the process of you hitting that 20% equity.
Absolutely.
Right?
It appreciated far faster than we were able to pay down the principal.
Yeah.
So that appreciation and kind of the boom in the market is what allowed us to get rid of PMI so quickly.
Yeah. That's a great example. So to our listeners, just keep that in your back pocket to revisit the value of your home, as well as how aggressively you're paying it down to hit that 20% equity mark to get rid of PMI. So back to this call out though about the PMI version versus the no PMI version, where it's kind of baked into the interest rate. If you are making less than a 20% down payment on a conventional mortgage and there is no PMI, then they have more or less cleverly baked it into the interest rate. Now, what's the advantage of that? The advantage is that you start off with a slightly lower monthly payment potentially than you would with the PMI version, despite the interest rate being slightly higher. The disadvantage is that when you hit 20% equity in your home, nothing's going to change. They've baked it into the interest rate, right? So you're not dropping that off. So you may actually be paying a little bit more over the entire life of the loan than you otherwise would have if you just went with the traditional PMI option. If you made less than a 20% down payment, you have to weigh the pros and cons of that. It may be worth doing the traditional mortgage with PMI and then just having a plan to aggressively pay down the mortgage until the PMI disappears. And depending on what that PMI charge is, if it really is between that 0.25% to 2% of the loan amount, you add that on to a mortgage rate, at least at the time of this recording, of around 7% plus or so, you're looking at a really attractive, quote unquote, return by aggressively getting that paying down that mortgage to get enough equity in your home to reduce or eliminate the PMI. Excuse me.
Absolutely. And I think there's a great kind of blended or complementary point to make here, where if you are paying additional early in the mortgage in order to get rid of PMI, that additional payment that you're doing is also going to reduce the interest that you pay over the life of the loan, because 90% of a mortgage, 90% of the interest you will pay on a mortgage is front loaded, right? So the first 10 years, it's front loaded in the first 10-ish years of that life of the mortgage. And by paying extra, especially in those first 10 years, you're going to greatly reduce the amount of interest you pay. For many people, it would be in the realm of hundreds of thousands of dollars with these interest rates and current home prices.
It's a great point you make to pivot to the mortgage length that somebody should choose, right? That's a good pivot to making that decision, 30-year, 15-year, what options should you select, right? I have an example that I prepared for us today to talk about just what you talked about, the saving on the mortgage interest. But when it comes to what length you should choose for your mortgage, again, go back to the fundamental questions. What is your cash flow like? What is your emergency fund like? Do you have a stable job? Do you have multiple incomes, or are you by yourself, right? So there's a general rule of thumb, which I don't take a rule of thumb too seriously. I think there's always nuance to explore, but often you'll hear the 28% rule, right? Like your monthly mortgage payment should not exceed 28% of your gross monthly income, right? So if you made $1,000 a month, then 280 should be your max. Although I'm using small numbers for easy math, but there are these kind of rule of thumbs that you can follow to give you a sense of where your mortgage payment maybe should land within your budget. But I would invite you all to go a little bit deeper than that and consider other angles too. So to the 30-year versus a 15-year, for example, for a 30-year mortgage, generally slightly higher rate than, say, a 15-year mortgage. But the advantage to a 30-year mortgage is you have more flexibility, right? So you have less of a monthly mortgage obligation payment to make. So if you ever hit hard times, you're not locked into a 15-year payment schedule. Gives you some flexibility. And you also have the flexibility to pay it down quicker like you would with a 15-year anyway. Some people will do some interesting things where they make payments, twice a month as opposed to once a month to try to mimic a 15-year payoff. And it usually comes out pretty close to the amount of interest saved. The 15 year is usually better because the rate you had on the 15-year might have been a little bit lower to begin with.
That's true.
It is there as an option. Again, I think flexibility is the name of the game when it comes to a 30-year.
We aim for flexibility and kind of the safety aspect, which is why when we refinanced, we went with 30 versus 15. The idea being that we know that as long as we can, we will pay extra towards the mortgage.
Yeah.
But should something, happen again, the safety net, right? If one of us no longer has employment, or if we have to live off of the emergency fund for a while, we can drop down to only that lower base rate and survive for a lot longer, kind of coast while we try to repair the situation, whatever's going on.
Yeah, that's true. And those are all good points, right? I think to our listeners, as we're talking through these examples, be on the lookout for certain elements of different strategies that resonate with you the most, right? That really seem to be tailored to who you are and what your situation is, because those are good indicators that a certain strategy over another might be better suited for you and your lifestyle and your preferences.
I would think that a 15 years probably a little bit better for someone that has slightly higher risk tolerance. In some ways, if you're comfortable with that higher payment, I tend to lean more conservative and therefore went with the 30-year.
Yeah, no, you're right. I mean, for a 15-year mortgage, in general, you should be seeing a slightly lower interest rate on it versus the 30-year, but a little bit less flexibility, like you said. It's just going to be a higher payment. One thing I will say on it, though, is there, for one, if someone is the kind of person that struggles to have good savings habits, they just, behaviorally speaking, really struggle to hold on to cash and save, choosing a 15-year is one method of kind of forced savings habits, if you will.
That's
right?
fair.
So it's, if you are that kind of person, and as we know, one's home is often the bulk of their net worth and wealth over their lifetime, that's something to consider. If a 15-year mortgage would help you more prudently and responsibly manage your cash flow by putting it towards good choices like paying off a mortgage, right? It's hard to argue that paying down your mortgage quicker is an imprudent use of your cash, right? Then you could consider that. And another thing on the 15-year mortgage, there is this psychological motivation and benefit to taking whatever age you are now, adding 15 years and going, wow, I could be mortgage free at this age versus having to go an additional 15 years beyond that. So again, both have their pros and cons. You can be thinking about those. Quick call out, Danny, on a type of mortgage that is not as popular as a 30-year or 15-year, but people still use them. Although I don't know if they're as attractive in today's environment right now. Sometimes you'll hear these mortgages called a 5-year ARM or a 7-year ARM. ARM standing for adjustable rate mortgage.
Okay. You dive into this, and then I'm going to have a little history time with you real quick.
Okay, sure. So in general, the way these work is you have a fixed rate for a set number of years, maybe 5, maybe 7. I think you can even do 3. And that fixed rate is supposed to be lower depending on the environment. Sometimes it's lower than what you can get with a 30-year or even a 15-year, although I don't know if they are in today's environment. I haven't checked in a while. But after that period is up, 3, 5, 7 years, whatever it is, it changes to an adjustable rate. And that can be a double-edged sword, right? So if people bought these adjustable rate mortgages before rates shot up and their fixed period was coming to end right as mortgage rates started going up, well, they're probably hurting right now, right? Because they're seeing this interest rate skyrocket, up really high. The opposite could also be true, right? You could do it and then rates could drop, right? And then maybe it's not as bad as you thought it would be. I don't see these used very often. They're generally used by people who maybe plan to live in a single location for a short period of time, 3, 5, 7 years, and then plan to move afterward. Maybe it's like a unique career situation or whatever. In those situations, you could consider it. But I've even seen people in those situations look at these adjustable rate mortgages and then look at a traditional mortgage and still just ended up opting to go with the traditional mortgage, a 30-year or a 15-year, because they didn't see a super enticing reason to go with the adjustable rate mortgage. So
yeah, that's fair.
Just be aware of it. It's an option there if your situation's unique and it looks good. You said you had
so I was doing a little bit of research on the history of mortgages, and back in say the 50s and maybe into the early 60s, homes were actually, in terms of cost, they only cost around 1.5 to 2 times someone's annual wages, whereas in many places now, right, it's 10x the median annual wage.
Yeah.
So when mortgages were first instituted, they were a 5-year mortgage. And the way it worked was you put 50% down. For the next 5 years, you paid only interest. And then you made another 50% lump sum payment at the end. And then you
Like
owned,
a balloon payment?
kind of. And then you owned your home. And
my
as home
gosh.
prices continued to increase and wages have, for the most part, stayed pretty flat when adjusted for inflation, people, given the average person just couldn't afford a home over 5 years, loans started to be allowed to be increased, right? So then we get the 7-year, the 10-year, the 15. Most homes are so expensive now for the average American that almost all of us kind of default to the 30. If someone says, and I would argue, if someone says, I have a mortgage, we all think 30-year mortgage.
Agree.
Which is why someone has to call out something different. So now 30 years has become the standard to pay off a home. Remember, up from 5 at the beginning. And I believe that the federal government, I'm not sure which department, but probably Federal Housing Authority or something, right, is currently in discussions to possibly allow 40-year mortgages.
Oh, no.
And
oh, my gosh.
There's a danger here. We can get very complacent with this kind of decades-long debt.
Yeah.
And harking back to the point where I made 90% of the interest is front-loaded in the first 10 years.
Yeah.
If you are primarily just paying that interest and you move to a new home every decade or so, you are essentially just restarting and front-loading that interest again. So you truly have to be committed to a home or to aggressive payments in order to make really good financial progress with home ownership.
Wow, that is amazing. My mind is honestly blown. I've not heard that before. The history lesson you just gave.
That's really short. We probably later we'll do a detailed episode on just that history. But I'm gonna stop for today.
Okay. No, I also have to share a quick story to you and our listeners. I'll be quick, I promise, and we'll get back to the topic. But you inspired me to share a personal story that was kind of in line with what you said.
Okay, sounds good.
My dad, I was back home one time visiting, and this is some years ago. He pulled out this stack of papers, and he hands it to me. He's like, Chris, these are all the expenses that I paid to build my house, which, by the way, my dad built his entire house. Like,
that's
he
great.
built it. He hired somebody to help with an electrician, but he built the home, right? It's so amazing to hear these skill sets that our parents used to have that none of us have in different times we live in now. I wish I knew how to build my own home.
I think I could build about 50% of a shoddy home.
Yeah. I don't know if I'm going to fund your mortgage for that. Sorry, Danny. I'd have to charge you a very high insurance rate for the shoddy craftsmanship.
Sure.
So, but my dad showed me these papers, right? And he built his home back in, I want to say 1987. It was like a year before I was born, I think. His grand total cost for every expense, including parts and labor to hire the electrician, it was like around $40,000.
Yeah, it's pretty amazing.
His whole home. My parents remodeled their kitchen like a year ago, and I want to say it was like roughly, I don't know, probably not far off from that. I actually don't know what the cost was, but it was just an amazing story to hear, like how much the price of homeownership has gone up, the cost of owning a home. And I wouldn't be surprised if my dad's salary back in that day was, what did you say earlier? 1 to 2 times?
1.5 to 2 times the median annual salary was the cost of a home.
I am sure he was making $20,000 a year at that point, if not more. So yeah. Anyway, that was a really cool history lesson. Thanks for entertaining me with that. So, but back to our example about the 30 and 50 year, right? 50 year. Goodness. 15
Oh boy,
year.
it's coming.
I know.
Give it a few decades.
You've infected my brain now, and I've said it. I put it out there, and next thing you know, we're gonna have 50-year mortgages coming down the line. Goodness. All right, 30-year and 15-year mortgage. I did prepare an example for us. So just to show how much interest you saved, you had mentioned, you'd hinted at this earlier, Danny. So if you buy a $275,000 house and you make a 20% down payment, so you have a $220,000 mortgage, and you have two options, a 30-year and a 15-year on that. Let's say you have a 30-year at 7.5% interest and a 15-year at 7% interest, just a 0.5% reduction in interest, right? On the 30-year home, your monthly payment would be $1,538, and on the 15-year, it would be $1,977. So, about $440 more. But you save almost $200,000 over the life of the loan, $197,000 and some change. So by paying
50 basis point difference.
Yes.
By 50 basis points, 0.5%.
Yeah, 0.5%. 30-year versus a 15-year. And your 30-year payment was $1,538 a month versus $1,977 a month for the 15-year. And you save almost $200,000. That's really huge. And so when people see that, that can also be a motivating factor to either choose the 15-year option or do the 30-year option and do some type of making a few extra payments here and there to try and save that interest. So
one quick thing I think a really simple way to think of this, right? That little change makes a world of difference. We talk about how time is your greatest ally when it comes to investment growth and kind of your net worth growing over time and compounding, right? Well, that same force that allows us as individuals to grow wealth with careful savings and investment and time, that same compound force works against us with debt.
The inverse is true.
Yep.
Yeah, absolutely. That's a great call out. So, wow, I think we really nailed a lot of good points on that. The down payment and the length of the mortgage. Another thing we'll quickly touch base on, Danny, is traditional mortgage or an FHA mortgage, Federal Housing Administration mortgage. For most people, conventional mortgage, traditional mortgage is the way to go, I think. For the FHA loans, those are generally used for individuals who maybe don't have enough money to make a very large down payment. So they're going to be making a very minimal down payment, generally have below average credit scores or a high debt to income ratio, right? The qualification for an FHA loan is less strict than a conventional loan. But that also means the loan's less competitive, right? So you're generally going to see higher mortgage insurance premiums on that FHA loan. And by the way, on those insurance premiums, for a lot of FHA loans, it depends on the loan and the situation, but that insurance premium might actually be there for the life of the whole loan. It doesn't disappear ever, depending on the situation.
Okay, that's fair.
Yeah, and there's also restrictions too on if you planned to rent out your home to tenants. There are restrictions. You may not be able to do it with a house that you currently have an FHA loan on.
Sure.
And there's you can't do it right away, and you have to get permission from the lender after so much time has passed. There's some nuances there. So for most people,
those are kind of usage restrictions.
Yeah.
Something that I will also touch on with an FHA loan is the fact that very often they won't apply to older homes if those older homes are missing small little things that are not up to modern code. For example, we had a conventional loan. However, our current house would have been disqualified from an FHA loan. One example is that the little landings that are kind of in front of our front and rear doors to the front yard and backyard, those small landings don't have a guardrail. So little things like that can disqualify your home from FHA loans.
I love hearing these types of stories because I keep learning new things. I mean, I wouldn't have even known that, right? It's interesting to be aware of those types of nuances. So kind of rolling on the back of all these different things we've talked about, mortgage length, what length should you choose? How much of a down payment should you make? What type of mortgage should you go with? let's try to answer this question, Danny. Is there anything our listeners can do beforehand to improve their situation or their outcome? Anything they could do to prepare for that home purchase, to prepare for making that decision on type of mortgage, how long the mortgage term will be, and how much of a down payment. I think a couple things came to mind. The first one I was thinking of was from anything you could do to make yourself more attractive from a lending standpoint, improving your credit score, improving your debt to income ratio. These are all going to help you. One, it's not only going to enable you to qualify for more of a mortgage payment, but two, it may also decrease your interest rate too, right? Like if you're a good borrower, you're going to look more attractive to lenders. So that may help you have a more attractive rate and have more attractive options. A couple ways you could do that. Paying off debts, of course, right? If you pay down debts, you're improving your credit score. For the debt to income ratio one, this is interesting, right? So like when they calculate that, they're going to look at all of your debt obligations, and they're going to say, well, the fixed monthly payment for this debt is, I don't know, $500 a month. And so that's taking a hit to your debt to income ratio because you have a fixed monthly debt obligation of $500 a month, for example, that detracts
Absolutely.
from that. So if you have certain loan or debt balances that are getting pretty low, to the point where you could just kind of pay it off, right? Like the lender doesn't care if the balance on your loan is only $5,000, right? They may not even see that right away, right? They might just say, well, you have a $500 monthly debt obligation, and so that's going to decrease your debt to income ratio. But if you have like a low balance, any of these like low hanging fruit where you could just pay them off, and that fixed debt monthly obligation is just wiped clean, that could be an immediate hit improvement to your debt to income ratio, which could be nice.
The last remaining amounts of my student loans were one of those low-hanging fruits when we were going to buy this house.
Yeah. We have, my wife has a loan remaining that has a really low balance, right? It's, I say low balance because she's a nurse practitioner, a certified nurse midwife. So like low balance loan
relative to the start.
Yeah, exactly. I think there's one loan that has like $7,000 left on it, and it's a really low interest rate. It's like 3-point-something% interest. And we had refinanced it. It was from an old, her second bachelor's degree, and it used to be a private loan, and we refinanced it when rates were down to a 5-year payment schedule. So it was like 5-year payback at 3% interest or something. So the monthly payment was actually pretty high. I want to say it's like, I don't know, $600 a month for this this loan. Now, if we were trying to apply for a mortgage right now, the lender would see like they have a $600 debt obligation. Like that's a big chunk that goes towards a debt. Yeah. But what they don't realize is that it's a small balance remaining that has a low interest rate that we deliberately chose to refinance to a lower rate to save a lot of interest. And so if I really needed to, we could just pay it off because it's kind of low-hanging fruit, and we would immediately see an improvement to our debt-to-income ratio. I share that as a hypothetical example, right? So to any of our listeners, if you have a situation like that, that could be something to consider. The other thing too is like when you're trying to decide where to source your funds to make a down payment, as we said before, Danny, just to reiterate, you should really consider your emergency fund separate from this. So look for any cash you may have set aside outside of your emergency fund. Make what down payment you can that's not going to jeopardize your cash flow or your emergency fund. And if you can get as high as you can, and it's not negatively affecting other areas of your financial plan, then good.
I've got kind of an extreme idea.
Do it.
And some people are really going to dislike this, but here it is. If you as a listener are trying to buy a house, and maybe the lenders are thinking that your debt to income is too high, and you have a new car payment And I think that the average car payment that was just listed nowadays for the U.S. is about $750 a month.
Wow.
That's
Wow.
$750 of debt every month on this report. Sell that car, right? If you have to drive an old kind of junky car around for a couple years, maybe even just 1 year, while you get this loan and it looks better to the lender, then you can evaluate your finances after you have your home, and then move from there. But
That's
extreme example,
interesting.
sell that vehicle.
It is definitely unconventional for sure. But I mean, there are a couple things you'd have to consider. Like, are you underwater in the vehicle? Like, could you even
That's true.
sell it to cover the loan to begin with? But if the loan value is below what the car could reasonably sell for, then that's a different situation.
I would argue even if you're going to break even.
Even if you're gonna, yeah, I mean,
Yeah.
I guess at these interest rates for mortgages, right? I mean, currently, I mean, it's an interesting proposition, Danny. I haven't thought of that before. I'd have to think more on it, but I'm all for hearing unconventional ideas. Those are always fun and interesting.
Of course, I have a bias. This is coming from someone who has no car payments.
Well, I mean, I have another thing people could consider. It's not as extreme or unconventional as the car idea, but you could ask a family member for a loan, right? If you have that kind of relationship with your family and they have the type of assets to be able to do those types of things, could do a family loan or a family gift if they're very generous.
I thought that it had to be a gift, because the loan, if it is a loan, technically the person lending it to you has to sign like a non-compete that they won't pursue you for it, because the lenders usually don't want any kind of contradictory or competing claim to the property.
That's okay. Let me clarify. I wasn't thinking family loan as like an alternative to a mortgage. I was thinking more of a family loan.
Oh, for the down payment.
For the down payment, yeah. Thanks
but I believe what I just said.
Yeah.
The lenders still view it that way.
Most
of the time.
I don't think it would. I don't think it would be an issue. They will
accept it as a gift if there's writing that says it's a gift. But most of the time, from what I've been reading, they do not like loans if it's in the form of a loan.
I would have to double check on that, because a family member can make a loan to any of their children for any reason, right? They're just like, hey, I want a personal loan. Okay. It's a good call out. I'd have to double check. I don't know. I've not actually encountered that before, but
okay.
Let's assume that it is an option, just because I haven't double checked that.
Sure.
Let's assume you could get a family loan. One thing to be mindful of is that there's, I'm not going to go down this rabbit hole, but there's something called applicable federal rates. So the IRS actually has certain interest rates that a family loan must, at minimum, like at least be that rate, that AFR, applicable federal rate. If they loan you something below it, there's something called imputed interest, where this is going to sound ridiculous, but they will actually tax your parent. Like, say parents gave you a loan and the interest rate they're charging is below the AFR, the applicable federal rates. They'll charge imputed interest. It's taxable interest that your parents would owe. It's ridiculous. But the rationale behind it is you are giving them a loan at below fair interest rates.
God forbid you help your family members.
I know. And at that point, you're just like, just make it a freaking gift already. Like, like, are you going to deal with that? But I think if a loan's below $10,000, then the applicable federal rates aren't really an issue. But it's just something to be mindful of if any of our listeners are going down that route with a family gift of some sort or loan. The one thing I would caution against when trying to source funds for a down payment, I don't think it's smart to use additional debt aside from like a family situation. Like, I've heard stories of people trying to be cute with taking out a 401k loan, things like that. I just don't think you might be putting yourself in a tough position. There are a lot of things that could go wrong. So just be mindful not to.
I believe in terms of retirement accounts, there is kind of a government allowance that allows a first-time home buyer to take a small dollar amount out of a retirement account for a first-time home down payment, but there are requirements there.
Yes, there is there might be like I know, for example, there's an ability to tap into like an IRA account, individual retirement account. I think up to $10,000 for qualified first-time buyers, and you can avoid the 10% penalty if you're using it to buy or build a first home. But you have to be mindful. There are a lot of rules and eligibility requirements in order to successfully do that without triggering some type of penalty from doing that. Probably beyond what we'll be able to get into today.
Yeah.
But you're right. That is technically with folks who have an IRA account, there may be an option to tap into some of it for a first-time home purchase without incurring the 10% penalty if certain requirements are met. And that's the really important part to be mindful of.
And all of that being said, I think both of us are of the mindset that you never, if at all possible, touch your retirement accounts until you are going to retire.
Yeah, I mean,
there are unique circumstances for everyone.
Of course, there could be very pressing life situations where it could be warranted, but they should be rare, right? Yeah, I mean, aside from that, another thing you could recommend doing is shop around for rates, right? Talk to a couple different lenders. I would even encourage people to not only talk to direct lenders, like maybe you have a personal relationship with someone at a bank or a local credit union. You could check with those people on what kind of mortgage options they offer. You might also want to talk to a mortgage broker, right? Just to get a second opinion and see what other options there are. No harm in checking with both, right? A mortgage broker basically acts as like an intermediary between you and other direct lenders. So if they are a good mortgage broker, they should be putting your interests first and really going out there and trying to shop around for you to find you the best options. It could take a little bit of the stress and the shopping around burden off of your shoulders. But I generally recommend that people try multiple options, like talk to different people to really, quote unquote, diversify your shopping around for rates, if you will. But yeah, at the end of the day, Danny, I think just to sum up with some key takeaways to our listeners, think of all the different things we talked about, right? There are a lot of smart ways you could approach this decision. And there's not going to be a clear right or wrong answer. There's going to be a gray area. And that's where you have to really think about, what is your personal situation? What are your preferences? What are your habits? Be very honest with yourself. Like, what kind of person are you? And what elements of these strategies really seem to match with you the best? If you can answer that question, if you have a strong logic or rationale behind a particular strategy that really meshes with you, then that could be a good plan. Maybe you pick that and you move forward with it. But just take the time to really explore all these things and be mindful of your personal financial situation before making that decision.
Those are all great call-outs.
Yeah, I think that's all I had to say today. Hopefully there was some good wisdom, some good ideas for our listeners to take from this and consider. Really appreciate everyone joining us today.
Yeah, thanks so much, Chris. Thanks for your expertise in all of these different financial aspects, and to everyone listening. I'm getting there. To everyone listening, as always, have a great week.
Awesome. See you next time. Thanks.